For decades really, California real estate operated under a single, unquestioned assumption that prices would rise, that demand would always outpace supply, that the state's combination of desirability, scarcity, and economic power made it fundamentally different from everywhere else. A market apart, a market above correction. And for a long time, that belief wasn't just optimism, it was supported by the data. Year after year, prices climbed. Bidding wars became routine. Properties moved in days, sometimes hours. The idea that California real estate could slow down, genuinely slow down, felt almost theoretical. Something that happened to other markets, in other states, under different conditions. But in 2026, something is changing. Not loudly. Not all at once. The shift is arriving the way most important shifts do, quietly, gradually, and then with a force that makes it impossible to ignore. Longer listing times, more price reductions, a growing hesitation among buyers who not long ago would have moved without question. These are not isolated signals, they are a pattern, and that pattern is now visible across cities once considered untouchable. What follows is a look at 10 of them, ranked by the depth and significance of what they're experiencing, and what their stories tell us about where this market may be heading. The change didn't begin with a crash. It didn't begin with a headline or a moment of crisis. It began with something quieter, and in many ways more revealing, a shift in behavior. Sellers started waiting longer for offers that used to come in hours. Buyers started walking away from deals they would have accepted without hesitation 12 months earlier. The bidding wars that once defined California's housing culture began to thin out. Price reductions, rare, almost embarrassing in the previous cycle, started appearing with increasing regularity. Inventory began to build, not dramatically, but measurably. And underneath all of it, a psychological shift was taking hold. Buyers were no longer chasing the market. They were questioning it, wondering whether a property worth fighting for today might be available, at a lower price, in 3 months. That kind of hesitation, once it sets in, is remarkably difficult to reverse. It creates a feedback loop. Slower sales lead to more inventory. More inventory leads to price pressure. Price pressure reinforces the hesitation. What follows isn't a prediction of collapse, but it is a clear-eyed look at what's already happening, city by city, number by number, in a state where the story of endless growth is meeting, for the first time in a long time, the weight of reality. Starting at number 10, Sacramento. There is a particular kind of vulnerability that comes from rising too quickly. Sacramento experienced that rise almost perfectly during the remote work migration wave. As Bay Area professionals suddenly found themselves untethered from their offices, Sacramento looked irresistible, significantly more affordable, close enough to feel connected, large enough to offer real city amenities. Demand flooded in almost overnight. Prices responded accordingly, sharply, rapidly, with the kind of momentum that felt self-sustaining. But what rises on the back of a specific temporary driver carries a specific structural risk. When that driver fades, the support fades with it. In 2026, the return to office reality, however uneven, has reshaped the calculus. Price reductions in Sacramento are becoming more frequent. Inventory is climbing beyond what seasonal patterns would suggest. The market isn't in free fall, but the imbalance between where sellers price their expectations and where buyers are now willing to transact is growing. And growing imbalances in real estate have a way of resolving themselves in only one direction. Number 9, Riverside. For years, Riverside served a specific and important role in California's housing ecosystem. It was the escape valve, the place where buyers priced out of coastal markets could still find something attainable. That affordability narrative was real, and it drove genuine, sustained demand. But affordability, it turns out, is not an absolute condition. It's a relationship between price and financing cost, and when interest rates rise sharply, even the more affordable markets find themselves recalibrated. In Riverside, buyers who stretched their budgets to the edge of what was manageable are now stepping back entirely. Listings that would have generated multiple offers are sitting. Days on market are extending. Sellers who bought into the idea that Riverside's relative affordability made it correction-proof are now confronting a more complicated reality. The correction here is not about luxury pricing or speculative excess. It's about the quiet exhaustion of a buyer pool that simply can no longer absorb the combined weight of elevated prices and elevated borrowing costs. Number 8, Stockton. Every market has a memory, and Stockton's memory is longer and more difficult than most. The city experienced one of the most severe housing crashes in the entire country during the 2008 financial crisis. Foreclosures, abandonment, a collapse in values that took years to recover from. What followed was a genuine, if fragile, recovery. Prices climbed, investment returned. The narrative shifted toward resilience. But in 2026, that fragility is reasserting itself. Prices are softening faster than in neighboring markets. Investor activity, which played a meaningful role in driving the recovery, is pulling back noticeably. The sensitivity that has always characterized Stockton's relationship with broader economic conditions is reemerging. This is what markets with difficult histories often do. They lead the cycle on the way down, just as they lagged on the way up. The recovery was real, but it was also conditional, and those conditions are changing. Number 7. Fresno. If Stockton offers a dramatic signal, Fresno offers something subtler, and in some ways, more instructive. Because the most dangerous corrections are not the ones that announce themselves loudly. They are the ones that develop quietly, gradually, in ways that are easy to rationalize away, until the moment they can't be. In Fresno, inventory is rising without urgency. There's no crisis atmosphere, no sharp headlines, no dramatic listing spikes. And yet prices are beginning to edge downward. Sellers are making concessions they wouldn't have considered a year ago. Buyers are taking their time in a market where taking your time was once a losing strategy. This is what the early stage of a real correction looks like. Measured, almost calm, easy to dismiss as seasonal noise. But the data doesn't lie. And the direction, while not yet dramatic, is unmistakable. Number 6. Bakersfield. Bakersfield's recent housing history follows a familiar California script. Affordability attracted migration. Migration drove demand. Demand pushed prices upward. And upward prices eventually pushed buyers to their limits. The city benefited genuinely from that cycle. Values rose. Activity increased. The market for a period had real momentum, but momentum is not a permanent state. In 2026, demand in Bakersfield is showing clear signs of fatigue. Buyers are hesitating in ways they weren't before. Sellers are adjusting prices more aggressively. Not because the market has crashed, but because the gap between asking price and transactable price has widened enough that holding firm is no longer a viable strategy. The market here is not reversing sharply, but it is reversing, and the direction of that movement matters more than its current speed. Number 5, San Diego. San Diego occupies a particular position in the California housing conversation. It was, and in many ways still is, considered one of the most fundamentally resilient markets in the state. The combination of military presence, biotech employment, tourism, and consistent desirability gave it a kind of structural stability that other California cities couldn't claim as easily. And yet, in 2026, only even San Diego is showing the pressure. High price points combined with financing costs that have eroded buyer purchasing power significantly are shrinking the pool of qualified buyers. Price reductions are appearing in neighborhoods where they were essentially unheard of 12 months ago. The drops aren't severe. Not yet, but that's almost beside the point. What matters is that they are happening at all. In a market that prided itself on near immunity to correction, the presence of visible price declines is itself a signal. And signals in premium markets tend to carry weight, precisely because they come so rarely. Number 4, Los Angeles. Los Angeles defies easy summary. It is not one housing market. It is dozens of micro-markets layered on top of each other, each responding to its own set of drivers, its own supply dynamics, its own buyer demographics. That complexity has historically been one of its strengths. But in 2026, the fragmentation that has always characterized Los Angeles is taking on a different character. The micro-markets are diverging, not randomly, but in a way that reveals underlying pressure. Some areas remain stable, but others are seeing clear, measurable price declines. The patchwork is becoming a map of stress, and the expansion of that stress, the way it is spreading from neighborhood to neighborhood, from one tier to the next, is what makes the Los Angeles situation worth watching closely. Fragmentation in a market this large doesn't stay fragmented forever. It tends to resolve in one direction or another, and the current direction is not up. Number 3, Oakland. Oakland's housing market has always existed in a complex relationship with the broader Bay Area tech economy. As that sector expanded, so did demand, driven by workers who needed proximity to San Francisco or Silicon Valley but couldn't access pricing at that level. The dynamic created real appreciation. Neighborhoods that had long been overlooked experienced genuine transformation. Values climbed. Investment followed, but the same connection that fueled the rise is now creating a different kind of pressure. As tech hiring has slowed, as layoffs have accumulated, as stock compensation has lost some of its power, as the certainty of the sector has become more conditional, the buyer pool that drove Oakland's appreciation has thinned. Price reductions are more common. The urgency that once pushed buyers to move quickly has faded. What's emerging in Oakland is a lesson in how directly and how quickly a housing market can reflect the employment reality beneath it. Number 2, San Jose. San Jose is Silicon Valley. Not symbolically, literally. It is the geographic and economic core of the technology industry that, for the better part of 2 decades, drove some of the most extraordinary housing appreciation in American history. Properties in San Jose didn't just hold value, they compounded it, year after year, in ways that seemed to operate by fundamentally different rules than markets elsewhere, which is exactly why what's happening there in 2026 matters so much. Reduced hiring across the sector. Stock volatility that has eroded the paper wealth that fueled down payments and confidence. Affordability ceilings so extreme that even highly compensated buyers are finding themselves at the edge of what is financeable. These pressures are converging, and they are producing visible results. Price declines in San Jose are not marginal noise. They are a structural signal from the very center of the market that defined California's housing narrative for a generation. When the core softens, the implications extend far beyond it. And then there is number 1, San Francisco. Because if there is a single city in California, perhaps in the entire country, that embodied the myth of the permanently rising market, it was San Francisco. The supply constraints were real and severe. The demand was global. The wealth concentration was extraordinary. For years, every signal that might have indicated a slowdown was absorbed and overridden by the next wave of demand, the next cycle of hiring, the next influx of capital. The city seemed, genuinely, to operate under different rules. But in 2026, those rules are no longer holding. Prices are declining faster than most observers expected. Inventory is building in neighborhoods where availability had become almost theoretical. The confidence that once defined the buyer experience there, the certainty that acting quickly was essential, that hesitation was costly, has given way to something else, something more cautious, more conditional, more uncertain. And what happens in San Francisco does not stay in San Francisco. The city has always functioned as a leading indicator for broader Bay Area trends, and the Bay Area has functioned as a leading indicator for the state. When confidence breaks at the center, the ripple moves outward. That is what is happening right now. What ties these 10 cities together is not coincidence, and it is not a collection of isolated, unrelated local conditions. It is convergence, different regions, different price points, different economic drivers, and yet the same underlying current running through all of them. A recalibration of expectations, a revision of assumptions that had gone unquestioned for years. The belief that California real estate was structurally immune to sustained correction is being replaced by something more complicated, more conditional, more honest about the limits of even the strongest markets. These declines may still feel manageable, and individually, many of them are. But the pattern is what demands attention. Markets don't transform suddenly. They transition, step by step, signal by signal, city by city, until the moment when the transition becomes undeniable. By then, it is already well advanced. California's housing market is not collapsing. It is recalibrating. But recalibrations have direction, and the direction of this one may only be beginning.